Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Covered Calls and Short Puts. And it's 2026, guys. Happy New Year. We're going to be rolling into the new year through, we're going to be doing something known as the wheel strategy. So it's an options income strategy that actually involves both of the approaches that we discuss in this webcast series, Covered Calls and short puts. So I thought it'd be a good way to kick off 2026. We'll talk about exactly what the wheel strategy is. We're going to be planning and placing an example trade. Before we can get to any of that, though, let me first of all say hello to everybody who's already chatting in out there in YouTube. I always keep my eye on those chats before the webcast starts. So hello there to all the familiar names. Hey there, Josh and E. Dunny, Chris B, JDLMI, Will, Debbie, Curtis, Selva, Kevin, Alfie, Noodle Brains, Eva, everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. Now, as I was watching those chats, I also saw a few names that weren't entirely familiar to me. So if you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream has concluded, well, enjoy the recordings. Those are a great way to watch these webcasts, but you're certainly invited to join us here in the live stream if you'd like to be in our live audience. This is a Monday webcast series, and we kick things off promptly at 2 Eastern Time. Love to have you here. But I also want to let my live stream audience members know that my good friend Barb Armstrong is hanging out in the chats. She's also been keeping her eye on the chat, watching for questions. If those questions come in and I don't have an opportunity to address those, Barb's there to pick up my slack for me. Thanks for having my back there, Barb. And Barb and I would like to issue an invitation to everyone listening, whether it's live or you're on the recording, to follow your favorite Schwab presenters on social media. You can find Barb and me on X. You can find Barb on X at Barb Armstrong CS. You can find me on X at Cameron May CS. Now you can also follow me on LinkedIn. So go to linkedin.com/in and then just throw on a / Cameron May CS. That'll take you to my profile there, and you can give me a follow there. But let's get right into this discussion. Now, as we do, of course, we need to keep this important information in mind. These strategies involve risk. Risk is real. So remember that options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. Okay, that was important stuff. Now that we've gotten that accomplished, let's set an agenda for today's discussion. So I want to talk about the wheel strategy, but before we can get to that, as we always do, let's have a look at our current example trades first. So we'll see if there's anything that needs to be done with existing positions. We already have, I think, 8 trades in place at the moment. I think there's one that probably needs some attention today. Then we're going to look at the markets to set the stage for our discussion of the wheel strategy. So we'll look at the S&P 500, let that sort of lay a baseline for our discussion of this wheel strategy that a trader might be contemplating as they're moving into 2026. I don't know. But we want to cover what the wheel strategy is, how it might generate income, what are some of the pros and the cons. And before we finish things up here today, we're going to start a possible new wheel by selling an example short put. All right. So before we get to, well, with that, I should just say, with that done, let's go to the Thinkorswim desktop trading software platform and have a look at the existing positions. So yeah, before we get to the wheel strategy discussion, let's see what we already have going on in our paper money portfolio. So here we have Apple. That's our first position. It's a short put. We sold the 265 put here. The trader, if they don't want to get assigned, may be looking for the stock to stay above 265. It's right now at 267. So early assignment is less likely when we're out of the money like this, but still possible. This trade is basically right about break even at the moment. So here's the Apple trade. This is the current trade. We've actually already booked an example profit on this previously. So previously we sold some December puts, and those expired for a 277 paper money profit. Now we've sold some January puts the 265 strike. We've collected 270 for those. That would actually cost us a little bit more than 270 to close those out if we wanted to right now. But there's that 270 level that I've drawn in here. Our break even is down here at 259.53 for the 2 credits that we've collected so far. And our plan here is to potentially consider selling covered calls if assigned. That actually hints directly at the topic that we're going to be discussing today, the wheel strategy, which really is rolling one income strategy into another, keeping that wheel rolling. I'll get into more detail in a moment. But for right now, we're still out of the money on these puts. They've not been assigned, nor will they be assigned early in paper money. We don't see early assignment in paper money. It's certainly a possibility in a real account. So that's an important distinction between paper and real. But this one, we're just going to let it keep working. You know, it's underwater, not $2 per share, not $2 per contract, basically just $2 overall. It's really a break-even trade. AbbVie, though, I think is probably one that we need to make a decision about today. Now, let's see. Lewis had asked this question when I use a scan, like, okay, maybe it's not a question, more of a statement. All right, I'll keep an eye on the chats, though. Anyway, our AbbVie position is a covered call. We own 200 shares. We bought those shares for $227.18. They're not doing very well right now. Now, against those shares, we sold 2 calls, the 240 calls. Those are now about $20, $21 out of the money, and they have really shrunk. So if we want to, maybe the trader might consider closing those out. Sold those for an original credit of $211. It would cost us less than 10% of that, 19 cents-ish right now to close that out, which is what I think we're going to be doing today. But what we need to do is decide, are we just going to be closing out those calls, or are we going to close out the whole thing? We actually have a plan for this trade, and it's getting, it's right there. So with this trade, we bought 200 shares for $227.18 right here. We sold some calls up here, the 240 strike, that's represented by this line up there at 240 for the 211 credit, which brought our break even to 225.07. We're below that break even, and I had a note here for us to consider closing this trade if the support breaks, and boy, we are right there right now. So what should we do? This is where the trader has to make a decision. I might look at this and say, well, has our 220 support definitively broken? We're $1 below that at this moment. It's kind of been chopping up and down right at about that support level for quite a good chunk of today's trading. We actually dropped quickly in early trading, but then we've kind of been going sideways right around there. Could that support actually hold? I know I drew a very thin line at 220, but support is typically seen as an area, and it might be an argument made that we're just sitting in that area of support. So I think with this one, what I'd like to do is wait till close, just have everybody keep watching the camera until the market's closed 2 hours from now, and then we make that decision as we get closer to closing bell. Can't do that. Can't do that. So either it's action right now, close this thing out, or hold on to it. I think we're going to hold on to this and see if that turns out to be the right decision. However, I do think that we're going to be closing out the call. Those calls that we sold for 211, we can probably close those out for about 10% of that investment, right, or not, of that credit right now. And how about we roll those? That's way out of the money up here. I wonder if we could roll down and maybe even extend this out. What if we were to sell? There is an earnings announcement. We'll keep that in mind. What if we were to sell a weekly contract expiring before that earnings announcement at the 230 level? Let's see what kind of a credit we might be able to achieve with that. So that earnings was on, okay, it's the first week of February. So as we go to the trade tab, we look at AbbVie. Let me look at the 30th of January. That's the last expiration. Yep, last expiration before that earnings. That's 25 days out. And if I look at the 230 calls, those seem to be trading in the neighborhood of $2. So that would be close to the original credit. So we might be able to sell, obviously, at a lower ceiling than we currently have, but maybe bring in more credit. At the same time, that might be lowering our break-even point. So let's maybe do that. Let's roll to this 30th of January, 230 calls. Looks like we might be in the neighborhood of maybe $1.90, $1.95 for those. So let's go to our monitor tab. I'm going to right click on the existing calls and create a rolling order. And this will describe this as a calendar or a diagonal. That's okay. That just means that we're buying some calls and we're selling some calls at the same time with different expirations. It looks like, let's tell the system exactly which ones. So we're buying back the 16th of January. It doesn't know which ones we want to sell. We were thinking the 30th of January, 230s. So let's select that right there. Might be able to net, yeah, if we pay 20 cents to get out of contracts we're in, and we receive a credit of maybe $1.95 for new contracts, around maybe $1.74, 75 credit. Let's back off on that, say that we're willing to settle for a little bit less. How about 165? I'll set that as my limit. There's not a guarantee this order is going to fill, but we'll see. So we're attempting to close out the calls that we're in, selling new calls at the 230 strike for the 30th of January. There is a commission to be paid to get out of the current calls and into some new ones. So that'll eat away at the potential net credit here. Let's send that off and see if we can get that filled. I'm going to let that maybe continue to work while we move on to our next trade. So right up here, there's the credit we're requesting. Looks like the market is around 175. So we're requesting a lesser credit than the market appears to be offering. That, I think, stands a good chance for a fill, but we'll see. So let's move on to our Amazon trade. And by the way, the rest of these are going to go fairly quickly because I don't think we're going to be doing anything with these. Our Amazon trade, we previously had 2 puts that we had sold. Sold 2 of the January 16th. Let's see, the January, I put there. I think I meant to put 26. Anyway, we sold 2, oh no, the 16th of January. Yeah, that's exactly right. Yeah. Anyway, the 215 puts for 370. Now, what we prefer here, if the trader doesn't want to get assigned on those puts, they prefer the stock to stay above that strike, and it's really well above that strike right now. We actually closed out one of those last week, and that left us with we closed one of those contracts for a 303 profit. We're just in one contract remaining. And that one is only worth maybe 30 cents, 40 cents. This one I'm going to let it continue to work because, you know, it's only 37 or 38 cents, 37 or $38. But there's a high probability if we just let it go for 11 more days, that becomes a realized paper money gain. Now, it's not guaranteed. There's a risk, but I think we're going to let that one continue to go. Good Koopa says, is diagonal usually used to roll a covered call? Well, it is to roll out of a short option into another option at a future date or a different strike price. Yeah, well, and a different strike price. Yeah, you'll see that as described as a diagonal. And by the way, there it is. We just closed that out for $1.65, or rolled it, not closed it out, rolled it for a net credit of $1.65. All right, so the AbbVie trade, we've lowered our, just to revisit this, let's go back to AbbVie. Instead of having a put up or a call up here, we sold a call right down here at the previous highs. And we carried that out to the expiration just before this earnings. But it looks like it brought in an additional credit of $1.65, or a net credit. So that would lower this break even by $1.65. So instead of a break even around 225, it might be 223.35, something around there. Maybe 223.40 because the extra penny is there. Back to our Amazon trade. I think we're just going to let that continue to work. 37, 38 cents left that might be collected if we can just get that expiration. It looks like a high probability of that happening. If we were to collapse and get assigned, maybe we'll start selling covered calls down there. With our Alphabet position, it's a covered call. We have a short call at 325. The stock is only at 316, so that call's still out of the money. And this trade overall, though, doing very well. This is a stock that we bought a long time ago for 199 bucks. Right now, We're obligated to maybe have to sell it for $3.25. That's not looking terribly likely at the moment. Here's what it looks like on a chart. So we bought the shares way back here. Sold recently some December calls. Those expired for a profit. Sold more recently some January calls. Those are still out of the money. The stock's been going up, which has been helping out our shares that we own. But we're capped up here at 325. Someone might choose to buy those from us at that level. Break even is way down here. We have a plan here to consider exiting the whole thing if the support breaks right there. That doesn't appear to be an immediate threat. So we'll let that one continue to work. Microsoft sold the 380 puts. The trader's probably looking for the stock to be above 380. Well, these were actually sold way out of the money and way out in time. These are 2-year-long contracts, and we've been looking for a little rally in Microsoft. We haven't gotten it yet. Still two years to go. Sold into those puts here. Stock's actually, it slipped quickly for about a week, and then it's sort of been chopping sideways since then. This one with our strike down here, our break even further below that. Let's wait to see if we can get a rally. So I'm going to leave that one on. NVIDIA, covered call, bought the shares at 183. They're worth more than that right now. Sold the 195 call. That's still out of the money. So the call is basically around break even, maybe a little bit underwater. The stock is doing well. Overall, that trade is doing well. Here's its history on the chart. Bought the shares here. Sold December calls, which were closed for a profit. Sold November calls, which expired for a profit. Sold January calls, which are still doing well. So that one, support hasn't broken. We're going to let that one continue. Visa was last week's trade. Another covered call. We have a stop in place on this one. Let's look at the chart. This one was a very short-term trade with a stop down here at 340. We allowed some significant wiggle room, and it looks like we needed that. Stock actually sold off after we purchased it. Now it's been rallying back up, and it's getting up close to that 357.5 call that we sold. So we bought shares at 354.5, agreed to maybe sell those to someone else for 357.5. That would be a $3 gain on the stock to be added to the credit that we received if we're assigned, and we're getting close to that. Assignment here would actually be max gain, theoretical max gain exit. We're just going to let that one go. And finally, we have Exxon. You see what happened with Exxon and Chevron and the rest? Let's see, the real Enrico Palazzo says, why does it say when I try to sell a covered call on the confirm and send window, the max loss is infinite? Even if you sell at the strike price, don't you still get the profit? Well, I can't speculate about why you are seeing that, but I can tell you one of the reasons why that we might, if we're putting in a covered call, if we have a stop order on the shares already, what we have there is an agreement to sell the shares one way, but also a request to sell the shares another way. And that can create, theoretically, a short stock position, which can come with an unlimited risk. Now, I don't know that that's why it's showing up that way on yours, but that's one thing that we might want to check. All right. So, and also, there's also the possibility that we need to make sure that we're talking about a covered call here where the stock position is owned. Okay. But yeah, most commonly, it's because we have a stop in place that we forgot about or ignored. Oh, question just came in. Hi, Cameron. Where do I find your last week's videos? You want to check out all of these trades? Okay, let me show you this. Let me just have a look at ExxonMobil, and then I want to show those who haven't seen the logic of why and when we placed these trades. You can go back and see these. I really like these video series because unlike so many other people out there on YouTube, they're trying to, like, I don't know what they're doing, trying to sell a program or whatever, and they make all kinds of crazy claims about trades that they've done in the past. My trades are on camera, so you can go back and watch them. So yeah, I think that's a great benefit of these webcast series. But let's look at ExxonMobil first. Our final covered call, bought the shares at 116. They're at 125. We've agreed, though, someone has the right to buy those shares from us for 120. That's a reality of selling covered calls. If they do that, we sell the stock at a profit and we keep the premium that we previously collected. So it would be a profitable exit, might not be the optimal exit, but that's the way a covered call can go sometimes. So here's ExxonMobil. So here we bought the shares at 116.81. We sold a 120 call for 220, and the stock was just kind of chopping around, started working its way up toward our strike price, and then boom, took off. This appears to be a function of what's happened between the US and Venezuela. Whatever the motivations are, it can also potentially have an impact on oil and oil-related companies, and that seems to be what may be happening here and on other companies like Chevron. But in any case, yep, we might have to sell those shares for 220, and if we do, that would be the realization of about, what would that be? $3.19 of gain on our stock, plus the 220 premium that we sold. So that would be a profitable exit if we're assigned. We have a plan here to consider exiting of support breaks. We got close at one point, but we're nowhere near support at this moment. Okay, so that one, we'll just sort of see how that one goes. Looks like it's in position for a theoretical maximum gain. But let's go to that question though. Somebody says, Cameron, how do I find your previous webcast? Well, number one, make sure that you're subscribed to our Trader Talks channel on YouTube, because that's where we post our webcasts. It's also where you can join our live streams. So Trader Talks Schwab Coaching Webcast is the channel name, and you can subscribe by clicking the subscribe button just down below the video. But this is where you can join the live streams like this one that I'm delivering right now. But you can also find our playlists of previous webcasts. You just click on playlists. Mine is called Covered Calls and Short Puts, and it's kind of toward the middle-ish bottom. So it's right here, Trading Covered Calls and Short Puts. If it helps, you can scroll all the way to the bottom and then just go up about 3 lines, and there it is. Click on View Full Playlist, and this is where you can see all of those these trades. I do one new trade each week. All right, so there we go. John saying, can I roll the 120 call? Could the trader do that? Right here, that 120 call that we sold for $2.20. What if we don't want to sell the shares? Could we choose to buy the contract back here? Maybe roll for a further out of the money strike, or maybe even closer to at the money, but with more time? We could do that, but that would absolutely, almost certainly, not absolutely. Absolutely is an absolute term, and I don't use those in my webcasts. But very likely, we're going to be locking in a loss on that call that we sold. So what was our call? It was the 120 call. Yeah, it would cost us $6. That would be a realized loss on that call. And then whatever new call that we sell, maybe that one works out. Maybe it doesn't work out. That could add to losses or subtract from losses conceptually. So yeah. Myron says, can we do a screen or a filter on Cameron May? Yeah, you can actually search for my name. Yep. Just go to the channel and search for my name. Yeah, and that'll filter for me. Anyway, but let's talk about getting into this new year with the wheel strategy. Rolling into 2026 with the wheel strategy. What is the wheel strategy? Well, let me look at the S&P 500 as we talk about the wheel strategy. What's been going on with the S&P? Well, it's just been going higher and higher and higher and higher, and it's kind of been bumping along a resistance here, but those lows have been pushing up. Hey, you technicians, what do we call this when the highs aren't going anywhere, but the lows are pushing higher? So the sellers are trying to push things down, but the buyers keep coming in with more and more force, retreating less and less. That's what's sometimes known as an ascending triangle, typically seen by a technician as a signal that the trend is likely to continue bullishly. It's not a guarantee, but that looks like a bullish behavior from the markets. We'll see if this turns out to be bullish, but let's say that our hypothetical trader here has that continued bullish outlook as they're looking out to maybe selling more puts, maybe doing more covered calls. Both of those are bullish strategies. So if this turns out to be the case, that's a pretty good market for these strategies. So let's talk about a wheel strategy. What is a wheel strategy? Well, it really stems from the idea of rolling options, rolling from one trade into the next. Rolling just means once one is out, once we're done with one trade, we're going to use the same order ticket to get right back into another trade. It's a different trade, but another trade. We just roll along. And it actually all starts, both of these, the strategy, the wheel strategy is oriented toward potential income, but it starts with selling a put. All right, well, what kind of a stock does a trader want to sell a put on? They can have whatever logic they prefer, but selling a put, it requires that we get into a contract where we're taking on an obligation to maybe buy some shares. So would the trader want to sell some puts and get into a contract where they might have to buy shares of a stock they have no interest in owning? Probably not. Probably going to be a stock that they wouldn't mind winding up in their portfolio for whatever reason. Maybe it's in a sector that they're attracted to. Maybe it's because of the way the stock has been behaving on the chart. Maybe it's because it pays a decent dividend and looks fundamentally healthy. There can be all kinds of reasons for selling a put and taking on that contractual obligation and maybe have to buy shares. But the stock that I want to talk about today, I selected for basically three reasons: price per share, liquidity, and what the chart is doing. All right, so let's say that those are our traders' priorities. And I want to look at Philip Morris. What's been going on with Philip Morris? Well, actually, I do need to take one step back. Let's go back to the S&P 500. And I want to look at this through one specific technical lens. And that is, if we bring up a trend indicator known as a simple moving average, this is an indicator that some traders use to gauge the strength of a trend, the direction of the trend, and maybe where the highs and lows, the support and resistance levels might be in a trend. So E. Dunny says, I realize it's a strange question. Could you sort of do a wheel strategy on the actual SPX? The SPX is actually not a tradable security. We can trade derivatives of the SPX or other things that I can't talk about in this webcast series. But just SPX is not directly tradable. Anyway, I know it's otherwise tradable in ways that I can't really get into because it's just a little bit outside the scope of this presentation. Anyway, but let's go to our simple moving average. And I want to add a 50-period moving average. This is just looking at average prices over the last 50 days and plotting those on a chart day to day. And what that does is we wind up with a line that looks like this. So this line shows us a number over here, 6809. That's the average closing price of the S&P 500 over the last 50 days. That's about 2.5 months. And that average changes over time. Obviously, back in June, when the S&P was lower, the trailing 50-day average was also lower. So what some traders will do is use this moving average as an indication of the trend of an index or a stock, but it might also act as a price floor and sometimes as price ceilings in the case of a downward sloping moving average. The concept here being, if prices were high and they come back down to average, maybe there are some traders there just waiting to get back in at more average prices. And it's interesting from at least this technical perspective. It's not a guarantee of anything, but it's interesting that this recent sell-off has taken us pretty close to that 50-period moving average, and we're starting to bounce again. So maybe trend appears strong, and we're relatively low within the cycles of that trend. So now let's apply that logic to Philip Morris. You'll notice that the 50-period moving average has been at least a serviceable area of support previously. It has been at least a serviceable area of resistance previously. And look at this, we've recently broken up through that moving average. And then we have a big, long hammer candle whose tail is still hovering above that trend line. Our trend is just starting to tilt up. For some traders, this might indicate that our stock is set to behave more bullishly from here. Once again, not a guarantee. But on that premise, let's just suppose that our trader thinks this is where I'm going to initiate my wheel strategy. So the wheel strategy starts, it's an income-oriented strategy, and it starts with selling a put. Let's say that our trader wants to pursue some income, but it's on a strategy, it's on a stock that they wouldn't mind owning in their portfolio. But if they do have to own it, maybe they prefer to own it at a lower price level. So looks like the tail of our candle and this previous low is right around 155. Right about there. There is an earnings out here in the future, so let's keep an eye on that. Pardon me. Hold on a second. Anyway, so let's maybe consider as an example, let's sell a put at the 155 strike. Let's go to our trade tab. Let's look for something expiring before that earnings announcement, which is again, first week of February. So if I go to the trade tab and I look at we're on the 30th of January, and that's probably just going to be the last contracts available again before that earnings announcement. What if we were to sell the 155 put? Looks like that's trading between 165 and 190. This would be the first part of our wheel. So wheel strategy. Let's back off of that. So step one, sell a put. So we're looking at maybe selling, we're going to sell the 30th of January. That's the 155 put. And that looks like that's trading for around 165, 190. We'll say about $1.75. Maybe we can get a little bit more, who knows? But here's what we're doing here. Conceptually, what's happening is someone is paying us $1.75 per share for a standard contract that's 100 shares with the weekly expirations. But someone is paying us $1.75 per share. That's on 100 shares. That's $175 that's getting paid to us, deposited to our portfolio. But in exchange, for the next 25 days, that trader has the right to sell shares to us for $155 per share. That's $5 below the current price. So the stock, conceptually, would probably need to go down before they'd have a motivation to sell us those shares. So let's think about doing that. Let's say that we sell this 155 strike, and that carries out to, we said January 30th, right? That's right here. I just want to draw in a line to represent when this thing expires. So then we can talk about what might happen between now and then. There we are. So let me redraw this line, edit its properties. Let's have it start today, January 5th, and let's have it end on January 30th. There we go. There's our line representing this put that we're selling. Let's see, Mike says we're selling the put because we believe the stock will go up and we can just capture the premium, correct? Right, Mike, but there's also the possibility it might go down, and that will increase the likelihood that the contract gets assigned. So we need to be aware of that. Okay, so what if it does what Mike thinks the priorities are, and I'm probably right, Mike. What if the stock goes up? And we get to the 30th of January, we're up here. Someone has the right to sell shares to us for 155. Are they likely to do it when they can sell those shares somewhere else on the market for 165 or 160 or 157? No, if price is above our strike, contracts are unlikely to be assigned. Somebody could get a wild hair, decide to undersell current market prices. It doesn't happen very often, but it's possible. So that's a possibility, in which case, if the contract doesn't get assigned, it just becomes a realized gain from that $1.75 that we collected. We're off the hook. We keep the $1.75, and maybe we roll into selling another put. Keep that wheel turning. Now, what if it retreats? What if the stock goes down? Let's say it goes down here at 153-ish. Well, if it's below 155 and we hit expiration, That means someone has the right to sell us shares for more than they are worth. There is a heavy motivation for them to do that. And as a matter of fact, we better just plan on having those shares sold to us at that point. So if the stock goes down below our strike, we get assigned the shares, especially if that happens, coincides with expiration. Shares are sold to us for $1.55. Well, now we own, or for $155, now we own the shares. We keep the $1.75 from the premium that we previously collected, so that $1.75 is a realized income now. And what might the trader consider doing with these new shares of Philip Morris that they own? And they could sell covered calls. So sell the put to kick the wheel turning. If the contracts get assigned, we roll into a covered call and we keep that wheel turning, generating income. Now, each time we do that, the new contract comes with its own potential risks and obligations, right? So with this short put, we know we might have to buy the shares at 155, even if they've fallen sharply in value. That's a risk. If we own the shares and we sell a covered call, well, now we have a fixed price that we might have to sell the shares for. Have to be aware of that. Good question just came in. Do we need to worry about earnings on February 4th? How long do we keep this trade? One point that I do want to make with the wheel strategy is if we're jumping off, if we're dismantling the wheel every time there's an earnings announcement, how long is our wheel strategy going to continue? Not very long, because earnings announcements are just a matter of fact with stocks that are traded on the U.S. exchanges. So I am not going to avoid this earnings announcement. We are going to allow the wheel to roll right on over that earnings announcement. Here's what typically happens over the course of a trader's career. I can't guarantee how anybody's career is going to go. But sometimes those earnings are going to go well. Sometimes they're going to go poorly. It's quite likely it works out sort of as a wash. That's not a guarantee, though. Okay? Not wheel long, says Eric. All right. Anyway, that's our wheel strategy, but we're going to kick this one off by selling this 30th of January call. Let's sell that, pardon me, put. The 155 put, are we still going to be able to get $1.75? Looks like we might be able to pull that out of it. Let's click on that bid price. Here's where the trader might want to pause and figure out how many shares do they want to obligate themselves to potentially have to buy. How about for this one? Let's just do one contract. Selling one put obligates us to buy, in this case, 100 shares at $155 anytime between now and the 30th of January. So let's see if we can get at least, what did I say, 175? I'm going to try for 175. That's closer to the mid at this point. We'll see if we can get that. Let's click confirm and send. We're going to try to sell that one put that Philip Morris. This doesn't stand for PM, end of day trading or anything like that. It's just Philip Morris. The 30th of January, 155 puts for $1.75. If we can get that, we have to remember to subtract out the commission to be paid, leaving us with a minimum acceptable credit for this trader entering this order of 174.35. Might be more than that. It just won't fill for less than that if it fills. And there's a little reminder here, please note that you've selected a weekly option series. Yep, we did that strategically because we have an earnings announcement coming up. Some traders don't want to hold this sort of a position over that earnings. If we get assigned, we're going to stick with it though. Anyway, we've selected a weekly option series with a non-standard expiration date. Okay, let's send that off. And the wheel is now turning. We sold that for 177. That's right, Eva. Proud Mary keeps on burning. That's exactly it. Let's see. You're just finishing the Stay Gold lyrics there. Yeah, I see the connection there. Let's see. What else did I miss here? I think we're good with that trade. Let's make another note here. I'm going to make a note that this is a wheel strategy trade. So I'm going to put a text note here. Consider selling, I'm not going to capitalize the selling, selling calls if assigned. There we go. It's not even calls. It's just a call because we only have one contract. So we'll be grammatically consistent with the actual position there. There we are. All right. So guys, we have kicked off an example wheel strategy for 2026. We'll see how this one plays out. Now, when might a trader decide, I don't want to do this wheel anymore? Well, this is a bullish strategy. So if the stock really starts behaving bearishly, selling puts, selling covered calls are bullish strategies. If a stock is really going down, maybe the trader considers exiting at that point. But right now, our 50-period moving average is sloping up. It's been acting as historically a good resistance and support level. We'll see if that proves to be the case in the future. But guys, we've accomplished what I set out to do today. I wanted to talk through our existing positions, look at the markets, and then discuss what the wheel strategy is and enter an example wheel strategy trade today. So yeah, this is what we do with our Monday discussions. If you enjoyed it, I certainly invite you to join me in this webcast series each Monday. But I'm going to let you go enjoy our remaining webcasts for the day. But as you do, also remember that you have a great big slate of educational offerings from Schwab Education. Starting with, if you haven't done this, make sure that you have subscribed to our Trader Talks channel on YouTube. As I mentioned earlier in the webcast, this is where you can join our live streams. You can also find the playlist for previous webcasts. So our channel name is Trader Talks Schwab Coaching Webcasts. You can find the live streams right here. You can find our playlist right here. You can even do keyword searches through the archives for items of specific interest, like somebody asked about just searching for me. Yeah, you can do that. Now, another thing you can do is follow your favorite presenters on social media. I would definitely recommend you do that. When the camera's not on, the only place to connect with us is through social media. People say, can I have your email? No, you can't have my email. You can connect with me through social media. So you can follow Barb and me on X. You can find Barb on X at Barb Armstrong CS. You can find me on X at Cameron May CS. We're both very active here, and if you reply to one of our posts, we just reply right back to you. So for example, at least I can just say for myself, I definitely make a strong point to reply to my followers on X. So like I just made this post today, and people are starting to reply to me here. So I'll just go in here a little bit later and reply back to those. Great place to connect when the camera's not on. But you can also follow me on LinkedIn. So go to linkedin.com/in and then add /Cameron May CS. That takes you to my profile. You can give me a follow here. And I post here as well. I will typically expand on my comments here because I don't have the character limit, which is fantastic. And if you reply to my posts here, I reply back to you. Yeah, Myra says, can you connect with me on the gram or on Facebook? Nope. Yeah, but definitely X and LinkedIn. Love to see you there. But guys, go enjoy the rest of our webcasts. Thanks for all the thumbs up. I can see 162 people watching the live stream right now. And as I click refresh, 61. That's actually a pretty high ratio. Thank you. When you click the like button on one of our videos, it sounds like applause to your presenter. But it also gives us a boost in the YouTube algorithm, helps more people find our webcasts. So thanks for doing that. Barb, thanks for helping out. Guys, I will look for you in a future webcast. I'll also look for you on social media, on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish the very best of luck. Happy trading. Bye-bye.